Welcome to Corporate Banking Snippets. Snippets are short descriptions of key concepts in corporate banking. This is one of 100 different snippets in the process of being uploaded to YouTube. This one is a financial accounting snippet and illustrates how the cash flow statement works. Cash flow statements were previously referred to as source and application of funds statements and also as funds flow statements. The concept behind these terminologies is to identify how cash has been generated within a company and how it has been consumed. Before we take a look at some numbers, let's just consider what the words cash flow mean. Operational cash flow is created by the company's core sales activity. Positive figures result in the generation of surpluses. Investment cash flow comes from the purchase and sale of fixed assets. Investment in new plant and machinery is a positive sign. Financing cash flow comes from the drawdown and repayment of long-term loans, dividend payments, and injections of new equity. Modest dividend payments and repayment of long-term loans are normally good signs. Here is the cash flow statement. We start with operational cash flow. Our first line is net income. This figure of $48 million has been taken from the income statement snippet already on YouTube. We then add back depreciation from the same income statement of $2 million because depreciation does not create outward cash flow, although it has been deducted from net income in the income statement. So we have an adjusted cash flow from operations of $50 million. In the next line, net changes in receivables, inventory, and payables in the last 12 months have released an additional $9 million of inward cash flow. To conclude on this section, we have a subtotal of $59 million for net cash from operating activities. Moving on, we need to consider the cash generated and consumed by changes in fixed assets, basically buying and selling land, buildings, plant, and machinery. This is known as investment cash flow. You can see that our company has sold fixed assets for $2 million and has purchased different fixed assets for $45 million. As bankers, our preference would, in broad terms, be to see our customers disposing of underutilized land and buildings and purchasing productive fixed assets such as plant and machinery. The $45 million shows as a negative figure in the cash flow because outward cash flow has been applied to the purchase of fixed assets, in this case using up most of the operational cash flow. To conclude on this section, we have a subtotal of $43 million negative for net cash from investing activities. Negative cash flow always sounds like there is a problem. In this case, the reverse is true. We want to see the company investing in its own business. This is what creates the negative cash flow. If the company is buying plant and machinery, then funds have been used to pay suppliers, creating outward cash flow. The third section of our cash flow statement is financing cash flow and accounts for transactions of a purely financial nature. These include long-term loans drawn down and repaid, dividends being paid, and any additional injections of equity. Retained earnings are credited to equity each year, but this is internal accounting. An injection of equity would be cash paid in by the shareholders, say from a rights issue. The figures for our company give a net position of $4 million negative for cash from financing activities. Cash has gone out for a dividend payment and the company's medium-term borrowings have been reduced. The overall position for all activities results in a cash surplus of $12 million, which will be the difference between the balances on the company's bank account at the beginning and the end of the year. We analyze cash flows by comparing the sources of inward cash flow with the destination of outward cash flow. The following slides show this methodology in graphical form. In practice, you will need to calculate exact percentages in order to develop data from which valid assessments can be made. Our first graphic provides our platform showing how inward and outward cash flows connect with each other through the company's treasury. Inward cash flow is divided between operational cash flow and cash from fixed assets sold, long-term loans drawn down, any new net equity paid in, and finally, any cash taken out of the bank. All of these activities funnel cash into the treasury. Then the treasury pays out, firstly for fixed assets purchased, then to repay long-term loans, to make tax payments, to make dividend payments, and finally, when there is a surplus, to pay money back into the bank. Let's move on to models more representative of corporate life. In this graphic, the optimal cash flow generated model, operational cash flow has been strong, with minor contributions from the sale of fixed assets, long-term loan drawn down, and an equity injection. These funds are funneled through the treasury to the purchases of fixed assets, along with smaller outgoings for the repayment of different long-term loans, tax payments, and dividends. Finally, a surplus of 10% has been generated and credited to the company's bank account. This model is optimal because most of the inward cash flow is coming from operations and most outward cash flow is going into fixed assets. It is, however, important that the investment is in productive fixed assets, such as plant and machinery, and not just speculative real estate. The next model is similarly optimal, except that a small deficit has been incurred to support the inward cash flow, i.e. to make it up to a level that meets all the outward cash flow. Providing the company has money in the bank to do this, and sufficient profits on which to base its dividend, this is probably okay. The next model is definitely not optimal. Operational cash flow is only 10% of the total. The balance has mainly come from selling fixed assets and drawing down long-term loans. A small amount has also been withdrawn from the bank account. These funds go into the treasury and then are distributed as a very mean 10% for the purchase of fixed assets, tiny amounts for the repayment of long-term loans and tax, and then a whopping 80% on dividends. This is probably terminal news for the company and bad news for the bank if we're lending them money. Unless you do the analysis, none of this is self-evident. Unlike balance sheets and income statements, cash flows can be added together, so as well as a picture for 1 year, you can get a view over, say, 5 years. Window dressing over such an extended period is virtually impossible, offering more transparency for the bank. Within a peer group, you can quickly determine which companies have the strongest operational cash flow and which companies have to sell assets or rely on bank loans to stay in business. To conclude, do try to understand the cash flows of your corporate clients. They are just as important as the balance sheet and income statements, but many financial institutions fail to evaluate them sufficiently because the process, as you've just seen, is moderately challenging. As bank facilities are repaid by cash rather than profits, it is certainly worth making the effort to understand the true cash position of your corporate customers. Check out our snippet on cash flow forecasts to understand how cash flow forecasts differ from cash flow statements.